Welcome to GRE. I'm your host, Keith Weinhold, with a rant on how conventional financial advice is so terribly god-awful. An outlook for tertiary real estate markets. Then, are you getting worn down from guilt tipping? I've got a proven solution on how you'll never pay a guilt tip to a business again. And finally, how do you arrange your investing in personal finances in a world that's uncertain and unsafe? All today on Get Rich Education. When you want the best real estate and finance info, the modern internet experience limits your free articles access, and it's replete with paywalls, and you've got pop-ups and push notifications and cookies disclaimers. Ugh. At no other time in history has it been more vital to place nice, clean, free content into your hands that actually adds no hype value to your life. See, this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point. To get the letter, it couldn't be more simple. Text GRE to 66866, and when you start the free newsletter, you'll also get my 1-hour fast real estate course completely free. It's called the Don't Quit Your Daydream Letter, and it wires your mind for wealth. Make sure you read it. Text GRE to 66866. Text GRE to 66866.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Los Angeles, California to Las Cruces, New Mexico, and across 188 nations worldwide. I'm Keith Weinhold, and this is Get Rich Education. When you pay for a low-level service item like a Chipotle burrito, and another human is looking at you to see if you leave a 20% tip on a digital payment terminal, does that make you feel uncomfortable? Well, now you're being asked to guilt tip. I've got a foolproof way on how to never get put in that situation again that I'll share with you later here. You know, sometimes you just hear something that triggers a rant. I recently heard an ad for a digital platform that helps you manage your finances, and what an awful and scarcity-minded way of thinking this reinforces. But this is actually what mainstream financial guidance looks like. All right, it was an ad for a digital platform trying to attract you there, and here's basically how it works. You set up your account, then based on your income and expenses, you set up your budget. And as you know, that is a bad word around here, a budget. It's not how you want to live long term. All right, then when you're close to hitting your spending budget for the month or whatever, this platform triggers a budget alert. Are you kidding me? You get emailed a budget alert. How convenient. Oh, geez. So much for living an aspirational life by design. What a dreadful idea. Like, someone that really wants more out of life would actually take effort to set up something like that. You would be building an architecture to establish life patterns that completely say, I think that money is a scarce resource. Now, in the short term, you've got to do what you've got to do, which might mean living below your means for a little while. But in a world of abundance, delayed gratification should be a short-term notion for you. I think that this type of platform that's centered around stupid budget alerts is so limiting. Gosh, you've got to feel cheap just saying that out loud, a budget alert. But anyway, that sounds conducive to this concept of scarcity-based finance called a debt snowball. Now, you can read about the debt snowball on Investopedia, but the debt snowball, that's basically how you pay off your debt with the smallest balance first, not the highest interest rate, but yes, the smallest principal balance. And what it basically says is, in the first step, what you're supposed to do is list your debts from smallest to largest, and that's regardless of interest rate, just smallest to largest based on the amount. And then the next step is that you make minimum payments on all of your debts except the smallest one, because you pay as much as possible on your smallest debt. And then the last step is you're supposed to just go ahead and repeat that until each debt is paid in full. That's the debt snowball. So according to that, why do they say to disregard the interest rate, which is your cost of capital? Because they say that when you pay off the smallest debt super quick, that you're going to be jumping up and down with excitement, and that it's going to motivate you to keep working hard to get debt-free. They say that hope is more important than math. That's this school of thought. And along the way, you should lower your expenses, cut spending, work hard, and add a side hustle where you can. Oh my gosh, that is all congruent with this debt snowball concept that we sure do not endorse here at GRE. I mean, that is 100% orthogonal to the world of abundance that we believe in. So often on your high interest rate debt, what you would do then is you'd make the minimum payments with this debt snowball, and then you focus it all on your smallest debt amount, regardless of interest rate. You heard that right. And it even advocates that you stop investing and just focus on that smallest debt amount, even if it's a low interest rate. That makes no sense. If you've decided that debt paydown is the best allocation of your first expendable dollar, all right, well, even if that were a yes, then in most cases, you'd want to pay down the highest interest rate independent of the total principal balance on each of your debts. I mean, that's arbitrage. But the even bigger question for you, almost existential in nature, is why is the best way to allocate your first expendable dollar on debt paydown anyway? Answer that first, because one of the first places to look is how you can leverage that dollar 4-to-1 or 5-to-1 as long as you've controlled cash flows. Now, sometimes there are instances where you'd want to pay down debt before investing, certainly, like a 20% APR credit card debt. That could be one such place. So could retiring a debt to help your DTI, your debt to income ratio, so that you can originate a new business loan or a new real estate loan first. All right, you might do that regardless of the interest rate on a loan. But my gosh, if we want to stick with the snowball analogy, since we're a few days from December here, instead of trying to push a debt snowball up a hill, just start rolling a cash flow snowball down a hill. When you buy an asset that pays you a monthly income stream to own it, that is constructive. Compounding your cash flows beats compounding your debt pay down. Instead of trying to push a debt snowball up a hill because you're cutting your one and only quality of life down, instead start rolling a cash flow snowball down a hill. And now you've got gravity working with you in the right way. That is the end of my rant. Hey, maybe I just feel like complaining a bit. My gym was playing Phil Collins and Elton John all weekend, so maybe that's a kind of what in the world kind of mood that it generated in me. I don't know. And hey, nothing wrong with Phil Collins and Elton John. I mean, those guys are truly talented singers, 100%. I just don't want to be working out to those guys. Michael Bolton, George Michael, that's not motivating me to hit 20 burpees, okay? Hey, well, I hope that you are set up for a great week. Be sure that part of it is that you are signed up for our live event tonight for 5.75% mortgage rates on Florida income property at grewebinars.com. Now, whether you're looking at investment property in Florida or most any of the other 49 U.S. states, there's a really nascent and interesting development that's been taking place for at least 5 years now, and that is what's happening in tertiary markets, smaller markets. I'll define tertiary a bit more shortly, but we're talking about metro statistical areas, MSAs, that are probably not under 100,000 population, not that small. From a rent growth perspective, what's happened is that over the last 5 years, tertiary markets have had similar patterns to bigger markets. And historically, these smaller markets have been more erratic, but in rent growth terms, tertiary markets have stabilized. Now, a primary market is something like New York City or Chicago. A secondary market, you might think of that as a Little Rock, Arkansas, where it's under 1 million in MSA size. And then a tertiary market, that's going to be somewhat discretionary, but we're talking about a population of 100K up to, say, 300K. And what's noteworthy is that there are now more analysts and investors that are bullish on vibrant tertiary markets. So let's talk about why this is happening. I think there's an emerging bull case for overcoming some of the historical roadblocks to tertiary market investments in a diversified multifamily or single-family rental portfolio. And one classical objection is that tertiary real estate markets are too volatile. Historically, we perceive smaller markets as more volatile, yes, and some surely are. But over these last 5 years, markets outside the top 50 in size were regularly more consistent. Okay, they avoided rent cuts in 2020. They recorded sizable but less lofty rent hikes in 2021 and 2022. And now they remain moderately positive in 2023, even as larger markets have kind of flattened out in their rent growth. And of course, we're talking about a composite group of tertiary markets here. Some are more stable than others. You got to watch those local trends as always, of course. And, classically, a second objection with these smaller markets is that, well, it's too easy to add a lot of supply. And yes, that is sometimes true, and sometimes it's not. Indeed, there are a handful of small markets that are building like crazy, like Sioux Falls, South Dakota, and Huntsville, Alabama. But as a group, the construction rate, and what that is the total units under construction divided by the total existing market. That is 5% in large markets versus a construction rate of just 4% in small markets. See, it can be harder to build in certain small markets due to NIMBYism or a lack of debt availability, especially if local banks aren't interested in the check size needed for construction loans. It can also be harder to build in certain small markets due to a lack of equity because it's a tougher sell to ask investors in a syndication to bet on a market that they don't have a lot of knowledge of. Another objection to these tertiary markets is that small markets are not liquid. Since 2019, sales volumes in dollars going into tertiary markets has doubled. Investor appetite has definitely increased in smaller markets. That's particularly true among these traditional regional investors that are looking for better yield as the larger cities got pricier. So good small markets, a lot of them really are not secrets anymore. And there's really one more objection to these tertiary real estate markets in that it is harder to scale operations. And yes, there is always benefit in efficiency of scale, but it's certainly been getting easier with better technology today. Investors can always work with top local property managers, and for investment property owners or managers, they often target small markets adjacent to larger markets where they have a bigger presence. So some other considerations before you as an investor go deep in one of these smaller tertiary markets is you want to be choosy in your market and in your site selection. Look for small markets that have multiple drivers. You don't just want these one-trick ponies. I've discussed with you before about how markets that are heavily focused on commodities or heavily focused on military, they are not favorable because those two sectors, for example, commodities and military, are just pretty volatile. Look for growth or steady eddy markets. Lots of small markets, they continue to grow at a pretty healthy clip. And you want to look for markets with an absence of new product. Now, why don't I name a few tertiary markets so that you can get a better idea of this? About 100K to 300K in MSA population size. Not that these next ones are necessarily good or bad markets. It's just for size comparison. I'm thinking about Ocala, Florida, and Shreveport, Louisiana. Those two, they're almost getting too big. They're almost secondary markets. Wilmington, North Carolina at 300K, that's a tertiary market. So are Akron and Canton, Ohio. Dayton, that's pretty tertiary, but it's also close to Cincinnati. So you got a little more safety in Dayton. Toledo is secondary. Burlington, Vermont is tertiary. Bellingham, Washington is tertiary. Yuma and Flagstaff, Arizona are both tertiary. Yes, we're talking about the stability in rents in tertiary real estate markets. Conventionally, in the past, I've said that MSAs of 500K population or more, that's pretty much where you want to be. But anymore, with the rise of remote work after 2019, it's really making some of these smaller tertiary markets more palatable to real estate investors and something that you probably want to consider. So really, that's the takeaway for you here. And see, this is the kind of stuff that really plays into my interests as a geography guy. See, I'm a real estate guy, but I might be the most geography-interested real estate guy out there. Geography is something that I really love. Though I don't share too much geography here on a real estate show. Sometimes it's relevant because both geography and real estate are location, but sometimes it's less relevant. For example, North America's longest river is not the Mississippi, it's the Missouri River. The New York City metro area is so populated that more than 1 in every 18 Americans live there. That's almost 6% of the entire American population. See, some of this is more trivial or of general interest than it is relevant to real estate, although you could learn some geography from me. Do you know the closest U.S. state to Africa? If you draw a straight line, the closest state to Africa is not Florida or North Carolina, it is Maine. Look on a globe. Part of the reason that Maine is the closest state is that Africa is primarily in the northern hemisphere, not the southern, contrary to popular belief. And to look at a different continent, the entirety of South America is east of Jacksonville, Florida. Here's one more piece of geography. Canada's beautiful and mountainous Yukon territory is larger than California, yet California has more than 900 times the population of the entire Yukon. Yes, the giant Yukon has less than 45,000 people. Is the practice of guilt tipping out of control, and how do you respond to our world that seems to be increasingly unsafe and uncertain? That's coming up next. They say if you give a man a fish, you have fed him for a day, but if you teach him to fish, you have fed him for a lifetime. Well, here at GRE, we do both. I'm not talking about both in terms of men and women, but we teach you how to fish and give you a fish. GetRichEducation.com is where we teach you how to fish with this show, with our blog and newsletter and videos. We also give you a fish. That's at GRE Marketplace. It's one of the few places you'll find affordable, available properties that are good quality there at GREMarketplace.com. They're all conducive to our strategy of real estate pays 5 ways. I'm Keith Weinhold. You're listening to Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
This is GRE Real Estate Investment Coach Naresh Vissa. Don't live below your means, grow your means. Listen to Get Rich Education with Keith Weinhold.
Welcome back. I'm your host, Keith Weinhold. There will only ever be one GRE podcast, episode 477, and you're listening to it perhaps on 1/3 of our episodes throughout this show's history. There is no guest. It's 100% me, a slack-jawed monologue like it is today. Hey, lots of great GRE episodes coming up in the future, including Robert Helms of the Real Estate Guys here soon as he runs alongside me for an episode as we discuss goals. If you get value from GRE and you don't want to miss any future episodes, be sure to hit subscribe or follow on your favorite podcast platform so that you're sure to hear from me again after today. Is guilt tipping out of control? We have all felt it. Now, does this happen to you today when you're about to pay the Starbucks barista or for the Subway sandwich and they spin the digital payment terminal around toward you and say, it's just going to ask you a question before you pay, and then they stand there and they look at you in the face and they watch what you choose? All right, does that right there give you a tinge of anxiety or even stress you out? Well, if you give into that, that is called guilt tipping. And you know what? I've got a solution to guilt tipping, a simple and elegant way that I'm going to share with you so that you never have to see a payment terminal like this in your face again that asks you for a tip when you're out shopping or dining and paying for something. Yes, I've got a proven solution for how you'll never even be asked to leave a guilt tip again because I tested it and mastered it. It works. We even have an unverified report on Reddit of a self-serve digital kiosk now even asking you for a tip. What? I mean, how far will this go? Yes, like a self-checkout for your own groceries at a supermarket like Giant or Safeway. First, let's get some context about why this is so important to you in the first place and how bad it's getting. It might even be worse than what you're thinking here. All right, a new study from Pew Research had found that 72% of people said that the long-standing practice of tipping is now expected in more places than it was 5 years ago. My reaction to that stat is, what? How is it not 100% of people saying that? It's happening all over the place, and consumers like you and I are increasingly getting tired of it. The way it works is that today's digital payment prompts, they allow businesses to preset suggested tip levels, so it's easier than ever for them to ask for tips, and companies that have not done so in the past, they are definitely doing it now. Rather than giving employees a raise, instead they're asking you to supplement the employee wage by asking you for tips where they didn't before. Must you fight back like David Horowitz? If you're uninitiated on that, I learned about a popular show that apparently ran on primetime network television in the 1980s. The show was called Fight Back with David Horowitz, and it advocated for how consumers can fight back against unscrupulous business practices. In fact, let's listen into the cornball intro of this show, which your parents might remember. It's something about fight back, don't let businesses push you around.
Fight back, don't let anyone push you around. Fight back, stand up and hold your ground. Fight back, if someone tries to do you in. Fight back, show them that they just
Oh, geez. Yeah, fight back against guilt tipping, I suppose. See, a few years back, the reason that you began getting asked to leave a tip in places you hadn't before, that's because it was a way for you to provide a gratuity for service workers because you were supposed to have appreciated that they showed up during the health crisis when a lot of workers did not want to show up. But now that the crisis appears largely over with, the tip requests have not gone away. They've gotten worse because by now, companies see what they can get away with. Now look, people don't want to feel like a jerk or a cheapskate. You don't, I don't, but businesses are taking advantage of that fact by making bigger than usual tips the default option on these payment terminals. And really, that's the crux of the annoyance. Say that you're given choices of 20, 25, or 30% on a payment terminal just for someone handing you a pre-made sandwich that's already wrapped in cellophane. I've had it happen to me. and then hoping that you will just go ahead and pay the extra amount rather than hassling with clicking custom tip and entering a smaller number like 10% or 0. Understand something here. The business, call it a sandwich shop, they're not the ones that always decide what tip options you're presented with. Did you know that? Because the companies that own the payment systems, they can earn a cut of your money from each transaction. Those payment system companies, they also have an incentive to increase those amounts as much as possible, not just the sandwich shop, but they are both complicit in this scheme together. But now, sometimes you get asked to leave a tip beforehand, before you're even delivered any good or service. And see, that's getting awkward too. And see, the fear that you and I should have now is that in this case, as the customer or as the client, you are going to get punished if you leave a low tip before they deliver the service to you. See, that's another big problem here with guilt tipping. Now, traditionally, tips were thought of as a way to reward good service after you already received what you paid for, right? That's how it works. You pay your server after a meal. You pay your valet after they bring you your car. You pay the tour guide after your volcano hike or snorkel tour if you thought that they did a good job. Now, just the other day at a chain fast casual Mexican restaurant that you've certainly heard of, I was being rung up about $35 for 2 double steak burritos, and there's a lower service level there than a full sit-down restaurant, but I left a 10% tip at the counter on that day. I thought they put lots of steak on them, and then I walked my burritos to the tables, and the tables were messy. I could not find a clean table anywhere, but I had already left the tip. It was too late, so I left the tip, and then only later did I discover the poor service, the messy tables. Well, gosh, I wasn't going to go back and try to undo the tip. Before I tell you about my elegant solution so that you can forever avoid guilt tipping, so let's understand just where are Americans tipping today? The situations when people add a gratuity, this really offers some insight into the new tipping landscape. And again, this is according to Pew Research. For dining at sit-down restaurants, 92% of people are tipping there. And of note, a majority said that they would tip 15% or less for an average sit-down meal. And that kind of surprised me because etiquette experts say that tipping 20% at a full-service restaurant is standard now, and that's what I do. Okay, getting a haircut, 78% of people tip today. Having food delivered, 76%. For those using a taxi or ride-share service like Uber, 61% of people said that they would tip. I tip for all those things. Buying coffee, only 25% of people leave tips. And eating at fast casual restaurants, only 12%. So look, people are upset because we've had years of high consumer price inflation and service inflation on top of that, and then a tip on top of that yet. So it's tipflation on top of inflation. And then there is this preponderance of restaurants, especially, that suggest that you tip the post-tax amount. Have you noticed that? That means that you're also paying a tip on the tax that you pay. So just pay attention to that next time you're at a sit-down, full-service restaurant, or really most any other place that suggests a tip amount. And yeah, that's annoying, and I really doubt that that business sends that extra revenue to the IRS where you're paying a tip to the tax amount. Gosh, but it all comes back to tipflation, the influx of automatic prompts at businesses like coffee shops. It gives you more chances to tip, and it'll just wear you down and then wear you out, creating this sense of exhaustion, thinking, what is all this for? It is just wild if supermarkets are asking you to leave a tip for self-checkout. Your supermarket wants to outsource their checkout duties from clerks and cashiers to you, asking you to scan your own groceries. By the way, that is an example of service inflation. And then they ask you for a tip on top of this food inflation and service inflation. You're doing it all yourself. What is next? You're going to have to unload the store's delivery of food from the 18-wheeler truck in the back onto a forklift and onto the shelves yourself? I kind of doubt that, but if grocery stores or convenience stores self-serve kiosks, if they're requesting tips, then it's more likely that soon enough your human checkout clerk is going to start requesting tips when you're checking out at Whole Foods or Publix or Wegmans or Safeway. That human checkout clerk, that's going to appear as some sort of small luxury comparatively. I mean, I would expect that to come to your town next. Expect to see it if you haven't already. There used to be this general understanding of what different tip amounts convey to servers and workers. Now, decades ago, it used to be a 10% tip meant, all right, well, hey, it wasn't horrible, but it wasn't great either. A 15% tip was normal, and 20%, that meant that person did an excellent job. But now those amounts have all become expected, and they've all been bumped up 5% or more. All right, well, here's my solution to avoid guilt tipping. The way to no longer see a digital payment terminal spun around, put in your face, putting you on the spot to make a nice tip is just this 2-word solution: pay cash. Yes, when you pay cash, you don't have to see an electronic payment terminal at all, and it's far easier for you to ignore a physical tip jar that's sitting on the counter over to the side of you. The elegant and simple solution to guilt tipping is to pay cash. Now, go ahead and leave a tip for good service if you want to. I'm not here to suggest that you stop all tipping. It's about how you can make an elegant circumvention of guilt tipping. If you have an 8-second long exchange where you ask for a cup of coffee and they turn around and pour it from a spout and hand it to you, and that's all they did, well, that tip's discretionary. The bottom line is that you don't have to tip every time you're prompted. And now, go ahead and hit up that ATM. With cash, you will be armed, and you can avoid guilt tipping completely. And hey, can we say that you will be fighting back like David Horowitz? Tipping is fine, but guilt tipping is out of control. And hey, if you want to see more on guilt tipping, I really brought it to life on a video recently where I really broke it down. That is on our YouTube channel. We are consistently branded, as they say. Our YouTube channel is called Get Rich Education, so you can watch me talk about guilt tipping and show you more over there. Do you feel like the world that you're living in is increasingly uncertain and unsafe, and is that adversely affecting your investment decisions? That happens to some people, and you can't make gains when you stay on the sidelines. I think some people make too much of uncertainty, even though it has always existed. Just look at the last about 4 years. You know, someone could have said, I am just paralyzed with inaction because of the pandemic. That's uncertain. Then the recession fears, uncertain. Then rising interest rates, where they rose fast, uncertain. And today it might be wars, uncertain. And you know, the same people that get paralyzed with uncertainty, they will soon say something next year like, well, it's a presidential election year, so I think uncertainty is going to sideline me again. If you wait for uncertainty to abate, such that you have complete clarity, or even great clarity, you're going to be waiting your entire life. Uncertainty and an absence of complete safety, that's existed in the world every single day since the day that you and I were born, and before you and I were born, and it will exist after we're gone too. I mean, really, just look at some of these disasters that have taken place just this century, and we're still in the first quarter of this century. And let's look here at some just in the U.S., not foreign crises. I'm thinking about the Y2K bug, the September 11th terrorist attacks on the World Trade Towers and the Pentagon, the Iraq War, the invasion into Afghanistan, Hurricane Katrina, where 1,800 people were killed, the Great Recession, the Arab Spring, the surprise of Donald Trump becoming our president in 2016. Remember, that was a real upset over Hillary Clinton. How about the jarring events of January 6th at the Capitol less than 3 years ago? The eviction moratorium, the slow creep of climate change, the riots and civil unrest with the George Floyd protests. I mean, I could go on and on about how winners just keep thriving despite a world that's constantly uncertain and unsafe. And I'm only talking about things that involve the United States here, and I'm keeping it confined to this century, just a little more than 2 decades. I mean, before that, we had world wars. We had the Dust Bowl, Cuba's Bay of Pigs invasion, and the Cuban Missile Crisis that could have led to a nuclear apocalypse that completely destroyed the entire world. There is relative clarity today compared to all that. How about an assassination attempt of our president, Reagan? I mean, things are substantially more certain today in a lot of ways. And today, American employment is strong, GDP is growing, our currency is fairly stable. Despite our problems, which will always exist, today, the U.S. economy is outperforming everybody in the world. And in a world that some feel is uncertain and unsafe, just consider the relative sense of certainty and safety you have today. Well, we discuss wars today, as bad as they are. When they do happen, they're never on U.S. soil. Can you imagine an attack on American soil? How would that sound? Like the enemy has destroyed and taken control of Charleston and Savannah, and next they're moving inland to take down Atlanta. I mean, that's so unlikely that your mind isn't even conditioned to think that way. But the reason that it seems like your world is getting less certain and less safe is because of media. Media is more fractured than it's ever been. It wants your attention. So with more competition, with everything from YouTube videos to TikTok clips now competing with legacy media, you get introduced to more fear in order to get your attention. My gosh, I mean, is American life safer than ever? You can make the case that it's become too safe even. I've talked to you before about how things could very well be in safety overboard mode in real estate. Now, here we talk about providing clean, safe, affordable, and functional housing. But sheesh, you need GFCI outlets all over the place in your property and carbon monoxide detectors and fire-rated doors, even when their improvement to your safety is negligible. American society at large is so ultra safe. And in fact, there's even a term for this now. It's called safetyism. Yeah, look it up. It's how excessive safety is becoming harmful to society. When you were on your last passenger plane flight at night and you just wanted to take a nice nap or you wanted to get some sleep, did the pilot come onto the intercom system and wake you up telling you to sit down and put your seatbelt on every time just a small amount of turbulence was being felt? There are endless instances like that where society's gotten so safe that it's just annoying. The last time that I was shopping at Lowe's, the home improvement store, a forklift driver was slowly driving the aisles really carefully. And besides just the forklift driver sitting on the seat, there was a second man, a flagger, that was out in front of him walking, holding 2 little flags so the shopping customers knew that a forklift is coming. Like, that's such a wild hazard to human safety. I mean, gosh, the gross inefficiency of that just to improve safety ever so slightly. Construction workers, they have to wear hard hats outdoors in an open field. I mean, our society has become uber safe. Now, don't get me wrong. Some measure of safety is definitely a good thing, but I'm underscoring the fact that historically, this world that you're living in is ultra safe and ultra certain. And then within our investing world, take a look around. What can be said to be certain and uncertain? Apple, they're the world's largest company by market cap at about $3 trillion. And their risk is that eventually they might fail to keep innovating. How about Bitcoin? Bitcoin could have government crackdowns or some other lack of certainties there. Money in the bank and owning treasury bonds. All right, that's fairly safe and certain, but you aren't getting any real yield there. And in a world that feels more uncertain and unsafe than it really is, bring it back to the positive attributes of being a real estate investor here. Monetary inflation is a near certainty, and so is the fact that people will pay you rent if you put a roof over their heads. Certainty. It helps to be mindful that safety is the opposite of freedom, and that having security is the opposite of having opportunity. Hey, well, speaking of opportunity, join our investment coach, Naresh, for GRE's live event. That is tonight. You can join from the comfort of your own home. You get to select from one of the two options for Florida income property. You can select either a 5.75% mortgage rate or the 224 program, which means 2 years of free property management, 2% of the purchase price in closing cost credit to you, and a generous $4,000 lease-up fee credit. Sign up. It's free. It's our live event tonight, the 27th, at 8:30 p.m. Eastern, 5:30 Pacific. If you're a few days late, be sure to watch the replay soon. Register at grewebinars.com to have a chance at putting some new build Florida income property in your portfolio. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.